Good evening to all of you. Greetings from Indian Overseas Bank to each and everyone who is in the concall. It's indeed a couple of things I just wanted to set the context with reference to what we had high discussion year before, and we set certain roadmap for the bank. I just wanted to touch upon the areas where we said that we are focusing and we will be in a position to move forward with that. First was that managing the liability was one of the focus. Liability side of the balance sheet was a great focus which we touched upon in last financial year. I can say with a fair amount of satisfaction that we were able to achieve with the plan of action what we have done it. The first thing what we did was we wanted to reduce our cost of deposit, which we reduced considerably from that of the 6.71% to that of 5.49%. This is one thing which we aimed at. We wanted to touch around 5.5. We were able to touch it. And regarding this CASA, we wanted to achieve around 38% as far as domestic is concerned. We touched around 37.4 in domestic and 36.45 globally. We have 8 branches across globe, especially in the southeast countries like Hong Kong, Singapore, Bangkok, and Sri Lanka. The couple of other things also we said that we are moved towards the rebalancing our credit side. That was one of the just before that, the liability side, we said that we will be shrinking our high-cost deposits and we will be reducing our dependency on the bulk deposit and we will be expanding our customer base. I can say that we added around 2 million customers during this period and which increased our retail term deposit, the considerable number, while our total deposit remained constant to the tune of around 2,11,000 crore. We were able to increase our CASA savings bank account, which grew by 5.55% during this period, which amply testifies the amount of customer service which is happening in our branches. And we also said that as part of our operations, we will be shrinking our, rationalize our branches and offices. During the last 1.5 years, we did around 191 offices and branches were merged or closed or things like that. We brought down our regional offices from 59 to 48 and we reduced our operating branches by 91 branches which are not viable. We have been merged and closed. Still another 77 plus 13 which comes to 90 branches have been identified for the closure in Q1 and Q2 of this year. So this rationalization is one of the areas which we have been focusing since last 1 year, which we are able to fairly achieve in that score. We also said that our delivery channels will be streamlined and they will be made to deliver better. And we have achieved our availability of the ATM to the low level of 70% to the current level of 92% of availability, which has reduced our operational costs. We have also closed during this period non-viable 671 ATMs from their locations, which reduced our expenditure by 17 crores because all these ATMs were operating on a OPEX model where we were paying a fixed amount of 25,000 to 30,000, 32,000, depending on the location, depending on the operations. This has brought down a considerable reduction in our expenditure. We also said that we are in the process of shrinking our office space and surrendering the larger spaces and move to new locations with less space, a lean and thin model of the branches, which we have fairly achieved. Around 14 crores have been saved in terms of rental expenditure, which is amply demonstrated as we move forward. Another very important thing which you said, the high-cost deposit will shrink. I can say that we are near zero as far as high-cost deposit is concerned. This is what we were able to achieve as far as the liability side is concerned. When we come to the asset side, we made very, very pitched effort that to move away from the book with a heavy corporate dependency to that of the retail, agri and MSME. We were able to increase it from that of the book size of 54% of the RAM to 66% of the RAM as we speak today, which is on the lines of our the plan of action, and this trend will continue to keep growing. We were able to reduce the RAM portfolio itself grew by 9.33%, and our retail segment all grew by 18%, and core retail grew by 26.26%, wherein the housing loan grew by 36%, and our vehicle loan grew by around 25%. Here, the purpose and the focus is to spread our concentration risk. We also said very consciously that we are bringing down our risk weight assets, which is around 112.x%, and I can say that we have brought down considerably down, and it is somewhere around, as of now, it has been brought down considerably to the tune of around 89.34%, which is a very good movement as far as the risk-weight assets movement is concerned. Another very important factors what we said is that we will be taking exposure only in respect of the good rated assets, and we were able to do that re-egging in our corporate books. We were able to reduce our corporate book high risk-weighted assets to the tune of around 9,000 crores, which were replaced by low risk weights, which you can observe in last 1 year. Our loan portfolio or the loan book size remained almost constant to the tune of around 1,51,000 crore, which we continue to maintain that. While maintaining the same size of the book, our risk weight has come down from 112 to that of, last year it was 107.89 to that of 89.34. This is exactly on the line of our growth. And if you look at the entire year, if I just look at one of the very, very focused area where we wanted to bring about improvement is that we said in the beginning of the year, our intention is to reduce our slippages and increase our recovery. If you look at Q1, Q2, Q3, we were able to achieve that in a consistent way. In Q1, we had a slippage of 2,720 crores, and in Q2, we had a slippage of 2,500 crores, and in Q3, we had a slippage of 1,300 crores. This was clearly went in the line of our plan, and we were able to realize those through our efforts of recovery. At the same time, in all the 3 quarters, we also said we will be increasing our recovery and upgradation, all put together total recovery, which went up in the first quarter from 2,700. That is, it was slightly less than the slippage. Then the second quarter, the recovery overtook the slippage. That is, through 2000, we were able to do 2,861 as a recovery, and in Q3 we made the recovery of 3,000 crores, which was double that of. But in Q4, although had the impact of the Reserve Bank of India's new circulars on restructuring of the stressed assets, the new framework for the management of the stressed assets, minus that, the trend would have continued the same way, because around 6,000 crores was what we have in 6,125 crores slipped on account of this particular portfolio. Totally, we are around 9,867, out of which 6,000, if you reduce it, our slippages would have been contained. Nevertheless, if you look at our structured book, I just want you to make a comparison with the restructured book of the last quarter, that is December end, and there is the current one. In December, we are around 8,960.82 as our restructured book. And right now, that has been 6,000 crores has went out of it, and we are having around 2,841 crores is what is remaining. These 2,800 crores is not a watch list. These are the accounts which were restructured. 5 accounts were restructured in S4A, and they are being properly serviced as per the IRAC norms. Recovery is in effect, which amount 155 crores. There are around 29 accounts which are small accounts, which are the MSME and other sectors, which have been restructured. These accounts are all being properly serviced and effectively serviced, which amounts to 1772. So they are all good accounts, and they are in a position to. We have around 4 accounts with 913 crores, which are all primarily 5/25, which is not a restructured book. However, we consider restructured in our last quarter. We mentioned about it, and these accounts are all being well serviced. So we feel that a restructured book with all the stress has been more or less addressed during this particular quarter, keeping in view the directions of the new framework which has come into that. Now, coming to the Q4 recovery, if I just look at it as a Q4 recovery on a standalone, we did around 5,725.96 crores, which is more or less in line with what has been done by us so far. Out of which we had around ARC sale as well as a technical write-off and cash recovery and upgradation all put together is a combination. So if I come to the financial year of my NPA, that is NPL book, if you look at it, opening balance was 35,098.26, and it just closed at 38,180.15. I just want to stress one point. It is not the GNPA ratio that matters. If you look at the GNPA ratio on a standalone, it may be 25.28. But I want you to look at as a numerator and denominator as 2 independent viewpoints. My numerator, there is a net effect of this numerator is only 8%, which is somewhere around 3,000 18 crores, 3018 crores is a net accretion of my NPA from March 17 to March 18, which is just 8%, which is one of the indicative factor of the fact that this is under constant, continuous monitoring and effectiveness is seen in this containment. Whereas this percentage of 25 to 8, when the numerator is under the fairly uncontrolled, denominator is a conscious decision of pegging it at the level of the last year. Had there been a growth in that, probably our percentage would have. So hence I wanted to say that it is more of the retaining the denominator at the same level we hit it. Had the denominator been grown, there would have been a different impact as far as the percentage is concerned. Now, coming to the provision, we had NCLT account 1, NCLT account 2 of Reserve Bank of India. These are the two things. Although Reserve Bank of India has given us a forbearance, asking us to spread it to 50% and 10% in this quarter as well as next quarter, we did not avail that facility. We provided for completely. In fact, our provision is slightly much more than what is expected out of this, because we provided in many accounts, even to the unsecured portion, and anticipating an haircut, we provided 100% also in some accounts. In the first list, we have 9 accounts as of now amounting to 4,951 crores, and this 71% has been provided for. In the second list, we have 17 accounts amounting to 3,211 crores, out of which 81% has been provided for. At the maximum, maybe 1 or 2 accounts, there would be some small migration provision, which in our view, as per the estimate, it will be to the tune of 100 crores, but it is nothing to do with the NCLT. But it is a normal IRAC-NAMS migration impact, which is likely to come during the June quarter. So if you look at the NCLT referred cases, 8,162 crores with the 26 accounts, we have an average provision of around 75% in these accounts. So looking forward, we see that there is an upside to it rather than a downside as far as this is concerned. Going by what has happened in last couple of months, we are hopeful and confident that around 50% of this will be unlocked during this, either in next 2 quarters or at least during this current financial year. When we unlock it to the tune of around 50%, there will be quite a good amount of write back from the provisions, as well as the reduction in NPA to the tune of around 4,000 to 4,500 crores, which will set right or offset whatever the incremental 3,000 crores which has been added to the NPA will be offset. There will be a reduction. This NCLT itself will provide me a net reduction to the tune of around 1,000 to 1,500 crores over March 17 GNPA figure of mine, without taking into consideration other recovery and other things which has been planned for this current year. Going by the past experience of the bank, we are confident that whatever the target set for the recovery, there is going to be a good impact, and near achievement or complete achievement of that particular recovery will also be achieved. In our recovery targets, we have not added this NCLT. Other than NCLT, we have set the target of reaching around 12,000 crores, which in our view is achievable from the 2 factors. We have the NPA divided into 2 components, that is 52% of my total NPA book is in the corporate side, which is something where we go along with the consortium leaders, and we are very few consortium accounts only we have. The remaining 48% is what we are looking at, and we have come out with a very, very non-discriminatory OTS schemes, wherein we have empowered our branch manager to the tune of 10 lakhs, and the regional manager from outstanding NPA of 10 lakhs to 1 crore, and zonal manager who is in the rank of a general manager is to the tune of 1 crore to 3 crores. These 3 things will get unlocked a considerable amount of our NPA during this year. We have put in place a very effective system of follow-up, very effective system of monitoring. We have totally digitalized the follow-up system, and we have developed a couple of apps, which we call it as IOB Sahayak, which helps us to track the work which is being done by my recovery officers. We have specifically identified 400 workforce in the field for doing the recovery in these small value accounts, which comes to somewhere around 38 to 39% of it. The remaining around 11 to 12% is in the books, is between 3 crores to 50 crores to sole banking. These accounts are 1,364 accounts are there. Here also we are confident of unlocking to the tune of around 30 to 40%, which will come to around 3,000 to 4,000 crores. So, as we move forward, taking into consideration what has been done earlier, we are confident of managing our NPL book, which is the biggest pain as far as the bank is concerned today. Then, having provided adequately, because our provision coverage ratio comes to the tune of around 59.45, which was only 53.63 in March 17. There is a considerable improvement in that. Then, coming to the profitability or our income side of it, we have consciously focused on our other income, and by giving a lot of thrust onto some of this para-banking and cross-selling of the products. This time, our other income grew by 11.08% over 17-18 and recorded a growth of 22.18% in Q4 over Q3. The interest expenditure has declined by 14.33% for the financial year and recorded a decline of 6.39% over Q4. This is mainly because of going for the higher CASA and the less amount of a bulk deposit. And the staff expenditure declined by 1.66%. The operating profit stood at 3629 crores, more or less flat with compared to the previous year. However, the operating profit almost nearly doubled when compared to the previous quarter. This indicates that operating profit parameters are under control despite the declining standard assets for us to do it. Our yield on advances stands somewhere around 7.5 and cost of deposit is 5.49. The big jump which we got yield has come down from 7.71 to 7.50 with 21 bits reduction, whereas our cost has come down from 6.171 to that of 5.49, it's a huge reduction. This provided us enough cushion in our 68 bits reduction in our cost of deposit has provided us enough cushion for building up our NII. The business per employee is continuously increasing from 12.28 crores to 13.10 crores. During last year, the Moody's investors who upgraded from our stable to positive, and S&P Global rating increased it to BB stable. Now, when coming to that of our our capital position, we were provided with 4,694 crores of capital by Government of India, which has provided us a fair cushion and one of the major reasons for absorbing this NPA declaration as the revised framework has been adjusted. Although we looked at our CRAR as the closing is 9.25, we are of the firm view that the CCB is it is a counter-cyclical buffer. If you look at that Basel definition, it also says that it is to be built during the fair time in order to meet the contingencies and pressures during the stress period. Now is the stress period for the banking sector, which is well recognized and well accepted. So this cannot be, considered as a breach or any of this lowering of what has been considered. This has been our stated stand. And with regard to our, with consistently coming down of our credit risk weight to the advance ratio, which was to the tune of around 94.57 in March 15. In March 17, it was 98.21%. Now in March 18, it is 69.51%. We are confident of building our books also because the risk weight is pretty low. One of the major strategies we brought in building the books and retaining is that RAM, and another one is our jewel loan portfolio. If you look at it, if I look at some of the NBFCs, they were able to build up that jewel loan portfolio to the tune of 30,000 crores or something, and which they are able to make a profit around 1,000 crores net profit. We have created a vertical within the bank, which we call it as a jewel loan vertical, which operates on a totally automated mechanism, and we have around 1,100 branches across the country which has been identified as express jewel loan counters. These are doing a jewel loan disbursement to the tune of around 10 to 15 lakhs per day. And we have been seeing a very positive movement. In March 17, we were around 10,600 crores. Now we have touched 13,000 crores as far as an outstanding of the jewelry loan is concerned, which stand testimony to prove that zero risk weight asset-based lending is increasing. And additionally, this particular portfolio is giving me a return of 9.45% when compared to our MCLR of corporate, which gives me around 8%, average of around 8.4%. Second important factor what we have been building up is in respect of the MSME. we were able to establish around 193 branches which are specially focused on MSME and 28 specialized branches in MSME. These branches have started. A bank, as on March 17, you look at it, we had a negative growth in MSME to the tune of minus 14%. Now we are positive with 7.6% of the positive growth, indicating thereby that this MSME sector, which is a branch-based credit expansion, is taking place. Previously, if you look at it around every day, on an average, 80% of the branches were a little shying away from giving credit. As we close this year, March 18, only 40% of the branches do not give any loan as at any given date. Now, if I take that as a weekly comparison of March 17 vis-a-vis March 18, March 17, in a week also, around 60% of the branches may not be giving disbursing loan. Now, that number has come down to 20%. If you look at a week, just only 20% of the branches might not have given a loan. 80% of the branches have given one loan or the other, primarily doing on micro and small, where the spread is also fairly high. It gives me a spread of around 10.45%. So this strategy of ours, which we set up in March 17, is started yielding and looking northward, and we are confident that this particular strategy will work during this year also, and we will be able to move up confidently. If you look at the composition of my loan book into the one which is outstanding as at the end of March, if my overseas is contributing to 8.27% of the loan book, and the corporate book is just 31.06%. So if I take overseas also as a corporate, technically we consider that also as a corporate book for our definition and discussion purposes. It is both put together, it comes to around 39%. The same in the year of March 17 was, if I combine both, it was around 47%. So we have come down by 10 percentage point in this portfolio, which itself is an indication that we are able to manage our books fairly well. Now, the second one is in respect of MSME, is 21.60% of my total loan book is in MSME, 20.41% of my total book is in agriculture, and around 19% of my total book is in the retail. This retail and 2 years before, were in March 14, was just 10%. Almost all these three portfolios ran, and over 1 year itself is moved from 54 to 66%. This shift is one which is facilitating us to have a distributed risk. Risk is getting, in the concentration risk is get distributed, and we are pretty confident that this will yield us a higher result also as we move forward. And our MCLR is as competitive as that of the market, and this is definitely moving forward. The one lingering doubt on all the minds is that the PCA, is there any restriction on expansion of the credit? Let me make it very clear. The expansion of the credit is restricted only to the high risk. I am not expected to get exposed to any of the high risk loan book, which we ourselves have decided to make it as a stress sector. As a model, bank's board has identified some 3 areas as a stressed sector where we keep ourselves away from taking further exposure. That is in respect of the steel, because one of my loan book, if you look at it, it is a high concentration of the loan book is in the steel sector only. The second, what we have set ourselves away from that was in power generation, where we have a fair stress book earlier. Now, although some of them have been resolved, but still we consider that as we keep away from that sector. The third was the port and roads. This is also another sector which gave us a lot of stressful time a couple of years before. So we are keeping away from these things. If at all we take exposure, we take exposure other than these 3 sectors in A+ and above only. Well, why we said A+ and above is we are having a large number of PSUs where the government guarantee is also available, which provides us an enormous amount of less risk advance opportunities. And this is one of the major shifts which moved in last 1 quarter, which facilitated us to contain our risk-weight asset also. So these are all the various steps which have been taken by us to stimulate or rather hold our fort. And some of the new products and services we launched both on the liability side as well as on the asset side. When you look at the asset side, we came out with a new product called SME 300. The purpose is that in micro and small, we wanted to vet the idea of MFI as well as keep the strength of the public sector. That is, we identify a micro or small in a cluster basis, maybe a trader, maybe a small shop owner, or there's a car dwellers, micro vendors. All these people will be extended loan, and our business correspondent will be meeting them daily and making a collection of maybe 200 or 300. What we have seen in MFI is that they lend them at a high rate of interest and collect it daily, so the delinquency is literally stopped. During last 1 year, I can say when it was launched almost 1 year before, this portfolio is building up very good, and we have around 100 plus crores. And just only 7 accounts are showing the signs of delinquency, which is hardly a few lakhs. This indicates that this model is sustainable and it is going to help us out as we move forward in meeting our... Here the spread is also fairly high. We get around 10.5% as a spread, plus 0.5% for incidental expenditures which we moved by sending the BCs. Like that, we have introduced a cluster-based approach as far as our MSME is concerned. We identify the related clusters in the places like Morbi, places like Ahmedabad, places like Ranipet, and where Hosur, in and around Chennai, Sriperumbudur and all those places, we devised the schemes which has the concessional margin, security and other things. And while giving a loan, most of these MSME, almost all the MSMEs, micro, small and mudra are covered under CGT MSME scheme, which functions as one of my risk mitigant and reducing my risk weightage in these sectors continuously. So even if there is a delinquency, we have 75% of it has been covered. But however, because of the close monitoring which we introduced in our SME sector, we have done 3 different changes as far as our monitoring mechanism is concerned. Number 1, all the accounts which become SMA, be it 0, 1 or 2, is assigned to individual employees of the bank irrespective of their role. Even the clerical staff, officers, managers and the regional office administrative staff are allotted the accounts which runs through, say, maybe 10 accounts or 5 accounts or 6 accounts individual. This gets allotted on the first 2 days of the month. And during the day, the system will prompt them to follow up. The follow-up is done in terms of telecall. The follow-up is done in terms of SMS. Follow-up is done in terms of emails and field visits. This is seeing us, the slippages is coming down, and we are able to make it consistently, make it as a habit. The cultural shift is what we are trying to achieve in our bank and making all these people to continuously follow up. We are confident that this will help us to achieve the desired goal of reducing our slippages. As I close, a lot of digital initiatives are being taken by the bank, and some of the digital initiatives, one simple example for telling the bank's position in the digital initiative is this. The Ministry of Electronics, central government ranks all the public sector banks based on digital transactions. We were at the beginning of the year at the bottom, around in the rank of around 18, 20, 30 plus. We are in the 30 plus. Now we have moved 15 notches. We are in the top band of 15, which indicating that our shift from the branch based to the digital is consistently moving. We have introduced the concept called the digital evangelist. The youngest staff of the branch, irrespective of the role, is called a digital evangelist. This digital evangelist role is to migrate transactions from the counter to the alternate delivery channel. We are seeing a good growth and consistent growth in this area, and as it is given as a KPI, these people are able to, youngsters are able to make a huge improvement in the digital adoption. With these measures, we are confident that this year we will be able to get out of our problem, and our motto for the bank this year is get out of PCA. This is what we have been giving in inverted quote. The entire team is working towards turnaround, and these are the various actions we have taken. Thank you very much. I'll leave the floor open.
Sure, thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may press star and 1 at this time.
I think that everybody is so very well clear.
Well,
we are not raising
we have a few questions. We have the first question from Sneha from Shubhkam Ventures. Please go ahead.
Regarding your targeting, you should be out of the PCA. What are the key parameters which you're looking that would be achieved by FY19? And how do you see your asset quality moving? So whatever the RBI circular, the pain has been over, how do you see the slippages going forward for the next year? And on the resolution NCLT 1 and 2, which is around 7,000, around 8,000 crore exposure, and which you're having a provision of the 75%, how much recoveries we are seeing and how much write back is being expected from that?
Okay. I'll go backwards. The first NCLT is concerned, we are confident that going by the various stages of the accounts, around 50% will be realized. It's a very conservative estimate, and it may go a little high as well. Around 4,000 crores will see us through this year, which will release at least, going by the haircut model, what we are seeing it, even if the haircut is to the tune of around 30%, there will be a write back. Even if you take it around 30-35%, there will be a write back to the tune of around 20-25% write back will be there from the provisions, which is a good amount when compared to 4,000, which itself is coming to around 1,000 crores. This is what is our estimate. So we have to wait and see as far as this, and we are pretty confident that this will help us to do it. And the second important thing going forward, we have identified some of these chronic NPA, whom we call it, where the provision has been made to the tune of 100%. We have identified them and then put them on a basket of sales to the ARCs. There are quite a good number of ARCs who are evincing interest in this MSME and retail portfolio. In the retail, we have a clean and our educational loan portfolio. We have already placed around 464 crores. 429 crores has been placed, and people are evincing interest in it. So we are confident that by this method, the small value to the tune of around maybe 3 or 4 times of whatever the number I said will get out of our NPA portfolio. And our recovery, if you look at it, there is a constant recovery efforts. Yes, I must say that in Q1, Q2, the recovery in respect of small loan was lesser, but that has started picking up because of the efforts of putting 400 people on the field exclusively for the recovery. There also we are likely to get around the amount of what we have been doing it earlier. So these 3 things will help us.
Meetings कम उन लोगों ने allocate किया था और आज सुबह साउथ इंडियन से मिली साउथ इंडियन 3 से मिले, सब कोटक में था, पूरा 3 days का BFSI कॉन्फ्रेंस ही था. इसके लिए का था, इसके लिए कम दिया था अपने को वो बेसिस पे, बट स्पीकर सेशंस बहुत अच्छे थे और 3-4 मिनट.
We'll move to the next question. The next question is from Nikhil Rangta from Bajaj Alliance. Please go ahead.
Hello.
Yes. Hello, Nikhil.
Hello, sir. So just couple of questions. First is by when do we see the slippages and the incremental new NPAs coming down? Because till the time that comes down, the interest reversal won't come down, and that won't help us in the NII front. So by when do we see the new incremental NPAs coming down?
New incremental NPA. Yeah. See, if you look at it now, we have now moved away from the quarterly recognition to the monthly recognition. What we are trying to do is that at the end of every month, we are in a position to reduce it, which has made, going by the past practice of the last 2 months, this has started building up or reducing by 50% of what has been done. So our estimate is that normally before all this stress and strain started in the bank, there were normal slippage up to the tune of around 500 to 600 crores, what we have been seeing it in quarter, and there will be a recovery of 400 crores. At the end of the year, there will be a net reduction will also be there. So there will be a net accretion to the tune of around 400-500 crores, netting off of the things. We looking forward, this is what we are anticipating from Q2 onwards. Whatever the little strain what we see, this may be in a position to see off in Q1, and from Q2 onwards, it is going to be business as usual. Because I can't rule out that nothing will slip. You know pretty well that there will be a very small portion. So that when I say business as usual means the account which otherwise have been slipping before the stressful period, only that will be left out. All other areas, because ours is totally, yeah.
Okay. And second is, we have seen few years of consolidation in our loan book, either stable type of thing. By when do we see loan growth kicking back in? Because once the loan growth kicks back in, other parameters will automatically fall in place.
Correct. Now, see, we have been consistently holding back our loan book for the last 3-4 quarters. You would have seen it. That is, what we did, loan disbursement is definitely taking place. Loan disbursement to the tune of around the recovery which has made last year 9,000 crores has been replaced by the fresh loan of 9,000 crores. And similarly, but to accelerated growth is what we are talking about. In my view, that we are now holding the fort at 151, which we may continue to do for a couple of quarters, and we will be maintaining at that stage, wherein the NPAs will be replaced with the standard as we move forward. So that will provide us a little incremental improvement in the revenue growth. From March 19 onwards, there will be a growth. Now, today, if I look at it, I get the demand also only from few sectors. We are of the view that looking at what is going to be unfolding of some of these road sectors and other things, it will start coming in Q3. Maybe in Q1, Q2, Q3, we will hold the fort. And Q4 onwards, we move forward.
Got it. All right, sir. That's it. Thank you.
Thank you. Thank you, Nikhil.
Thank you. The next question is from Sri Shankar from Prabhudas Lilladher. Please go ahead.
Sir, a couple of questions. While the optimism on retail, MSME growth and everything is perfect, where is it all on a sudden you are able to reduce your risk-weighted asset on advances? Have we gone for a lot of ratings of your advances in the last 1 year? You just made a significant change in your risk-weighted assets coming down. Can we throw some light on it, please?
Yeah. The first thing what has happened is we had the fair amount of book which is having BBB and below. And quite a good number of them are underrated with around 100%. What we did as a matter of thing, we stopped expanding in those areas which are around 100%. We told the people very clearly, if you look at my corporate book, it's come down by around 10%. These 10% are high risk, we exited. We consciously said that we will not be able to take further exposure on those. These 10% has been replaced by around 8 to 9% of housing loan, which is running to the tune of around 30 to 50%. And a considerable amount of jewel loan portfolio, which is 0%. You look at outstanding itself is increased by 3,000 crores in a year, which gives it straight 0%. So the high cost, high risk weight has been replaced with low risk. The another important thing what we did, yes, there was a data-related problem because LTV ratio. Take the housing loan portfolio of mine, which was around 9,000 crores, now increased around 13,000 crores. My book has built from over 1 year, around 4,000 crores has been built up. This has reduced my risk weight from 100 to the average of around 40 to 50%. Another thing what we did, the housing loans which has been given long back, if you just do the LTV, because the repayment has taken place, on the one hand, the cost of the properties are going up. On the other hand, my outstanding is coming down. When the LTV is beyond, it moved from 50% to 35%. The portfolio size of around 6,000, 7,000 crores moved in this way downward. That has also provided me a leverage. The third important thing what we did, the book cleaning was not attempted very vigorously. When I said book cleaning means, when I have an LG, LC and other things which is expired, which has been removed from the book, unavailed portion we have totally taken away. If the loan is given, either it is availed or it is not there on the book. This is one very, very conscious thing which is also removed very considerable amount of things out of mind. So this kind of conservative, the conservation mechanisms is enabled us to bring down drastically.
Okay.
And another one important thing what we did was that, see, this is something which I did as a very conscious decision. We did IBBC swap. What I did, there are certain banks who are looking for the high tickets with around 1% markup on that, 1 to 1.5% markup. I just gave it and took back 0%. That is, there are some banks who are having around 0% risk, but their capital cushion is very high. They said that, okay, 0%, I'll give it to you, give me a 100% risk of around 2,000 crores. They get a markup of 1%. By paying a 1% extra, I'm able to replace it. This is also another one method which I used.
No, but, sir, I didn't understand when you said your 9,000 crore, 8,000 crore or 9,000 crore home portfolio. Home portfolio. Has gone to 13,000 crores and 4,000 crores you increased in over a period of 1 year. And there
1.5 years.
1.5 years. And there you could reduce your risk-weighted assets, from 100 to 40. That I didn't really catch up.
Not 100 to 40. What I said, all the recoveries which are happening in my corporate book, unrated book, MSME book, these are all 100% risk weight.
Correct.
What I could have gone for the similar book building on those areas.
Okay.
We stopped the building in those areas. We moved away from mid-corporate and large corporate. These things we said that we will grow only in retail. If you see my total outstanding, it was 151 1 year before. Still it is 151 only now. So what I did, these things when I exited, it was replaced only by the retail book or rebalancing of my balance sheet, which increased to 4,000 crores, where the risk weight, had I disbursed 4,000 crores with 100% risk, my risk weight would have gone up. Whereas I replaced that whatever has been exited with a housing loan, where it is either 35% or 50% risk weight. So the average I took it and showed us as a 40%.
Sir, I'm sorry, I'm still coming back to it. It looks too good to be true. So if you can give some light on March 15, 16, 17, what was the rating profile of all your loans to that extent? How much of it was rated? And how much of your corporate loans and everything was rated? And what was the rating profile of those loans? And what is it in March 18? It will give a much picture clear. Because otherwise, what you are saying is highly subjective. There is no objectivity in what I am able to understand.
See, you look at my presentation also. If you look at a total credit risk weight of advance ratio of 94.57.
I'm in front of page 34, sir. It's open.
34, yes.
It's not clear at all. It doesn't tell me anything. It just gives
Any further details, I'll ask my team to send you the mail. Leave your mail ID. I can collect it from adverbs.
Yeah. And that's number one. Number two. So the problem when you have a 25% NPA, etc., what it says is your underwriting skills are not great. So now, what has the bank done in the last couple of years to change that underwriting skills and improve so that we do not have a problem going forward of this magnitude?
Correct. There are 3-4 things. These are the problems which is just coming out of those sectors which are stressed otherwise, number one. Number two, these sectors, our exposure has been set aside. Now we are focusing on RAM. What we did was, as I wanted to bring in a standardized way of doing the underwriting skill for my retail, MSME, and agriculture. Agriculture, leave it. Let us set aside. It's a very, very standard portfolio. What we did in last 1 year, where we are able to do is totally digitalization of my loan processing of the retail loan accounts. What we did, we have developed a package and integrated the package with the CIBIL, integrated the package with the NSGL. Through that, there are certain data scrubbing fintech companies through whom we have a tie-up. These leads when it come, and it is standardized through these packages, and it is bringing in a standard way of processing the loan. Too, we introduced one more thing. Our risk rating model has been developed in-house, which we call it as a scoring model. This scoring model was not available before for the retail and MSME. Now we introduced this scoring model. This scoring model, which we tied up along with the CRISL, which we were able to introduce for this entire portfolio of the retail and MSME. Since it is standardized, it is addressing, number one, the pre-sanction. It is bringing in the entire question of doing the same thing across the banks. The same model is available. We gave a very simple target. Every branch needs to do 4 to 5 loan of housing per month. It is not to be done beyond. For the simple reason, if you try to push it through a branch and try to do around 10 or 15, the possibility of due diligence compromise will take place, which we are able to address it. Another important thing what we did, we revived our intensive credit training, intensive loan appraisal technique training for the last 1 year, where we are able to pull out the people from MSME identified branches. And mid-corporate, we don't have mid-corporate because it's large corporate, but mid-corporate dealing branches and their credit officers. And in previous year, we recruited some financial analysts who were originally stationed only as a large corporate. Since our exposure is coming down, we are moved as a head of the small branches. Retail Mart has been created at 77 locations, wherein their focus is only to do retail in order to spruce up this particular book. So the underwriting skills have been developed over this period through training and through the bundling of our technology.
So when you are going this aggressive in your housing loans, it's good that you're looking for more secured kind of advances. Your yields will come under pressure. So what are the yields that we speak about out here in housing loans? And especially when you are going to link it to a lot to the CIBIL side, etc. Good CIBIL score invariably will come out at a lower yield to you. And what are the yields we are speaking about? Both
here in housing loan, my yield is around 9% average. Because of the high ticket as well as low ticket, put it 9.1 exactly precisely. And we are stopping it there because of the other area of our CASA we are focusing it, we are able to do that. It is working on a thin margin right now. Because right now I need to work on this thin margin because I have a constraint in the form of a capital. We can't have much beyond that. So unless I am able to manage the capital and keep it pegging down, this margin will not go up. This we will continue till this March 19th, then we will rework on our strategy.
So when you say 9.1%, this is for a CIBIL score of what? Housing loan. Because, there are competitors who are giving it a...
I'm talking about average. See, when I say average, it is across. I have a big ticket loan as well as a small ticket loan as well as a medium ticket loan. There are quite a good number of takeovers which are taking place in the big ticket loans. Previously, this was being, they avail all other loan from us and then move to some other bank for housing loan because there was a portfolio focus was not there. Now this portfolio focus has made these people to bring back my own customer to my own. This is an average. It is not pegged to one. Now, if you look at it, my lowest end is 8.50. Highest end is around 9.25, 9.4. These kind of things, it gives me an average.
Okay. Thank you.
Thank you.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. Next question is from Nilanjan Karfa from Jefferies. Please go ahead.
Hi, sir. So a couple of things. What is the strategy of getting out of this PCA? Secondly, do you foresee, return to profitability in FY19 or will still make a bottom line loss?
We are aiming for the quarterly profit at the end of the Q4. That is what we are working on to now. There, the thrust will be to reduce our NPA drastically, for which all the efforts are on. So Q4, if I make at least a marginal profit, we will be in a position to post ROA positive. This is one particular positive indications for the step towards getting out of the PCA. The second one is reducing my NNPA to the single digit is what we are looking at it, which is we are confident of achieving by the end of this financial year. That's again a Q4. This is another parameter which will move away from the PCA. The third parameter wherein we have to manage and reduce our stress on that is a CET1 where we are threshold level 1. We will be able to maintain the threshold level 1 in the Q4. And the fourth important thing with regard to this, ROA, CET1 and NNPA. These are the three factors which we will be able to adjust it. And Q4, I don't say that we'll be immediately getting out of it. That will be the starting block for getting out of it, because thereafter RBI guidelines also say that it has to be monitored for at least a period of 1 to 2 years. And I'm sure that once the indications are moving towards the positiveness, we will be able to get out of it in the year 1920. But the starting will be from March 19. That is a Q4 of this year.
Right. Sir, but you would also then need, capital support coming in from the government, right?
Yeah.
Basically, whatever the government had planned that, 2.1 lakh crore roughly for the entire sector. When do you expect we would get that second tranche?
The indications are that if you look at it, the government is just come out with the reforms agenda. The reforms agenda is having around 62 points of action points for implementation. I can say with pride that we have done a very, very large number of them to be achieved. Still that large time is there. So based on the parameter achievement, we will be considered as one to have a considerable chunk. Going by whatever it is, I feel that it may come in Q2. This is my feeling. We have to wait for indications from government on that.
Not this quarter?
This quarter, I do not know. Because right from we are not in a position to comment about it, I have to wait for the government. Because in this quarter is more or less, we have left it only 1 month. This is what I just calculated that it may be in Q2. This is again a guess. I mean, I have no very certain or information on that.
Okay, sir. And sir, a final question, as from a more, broader market perspective, people talk about this rising bond yields and, PSU banks not purchasing. So what's our status of the SLR book? Are we actually buying bonds? And, from, if not for IOB, then, why this perception, is it really...
The general thing is that almost every bank is having an excess of SLR built. They have built up the SLR. If you look at an average bank, will have around 70% of their bonds in the SLR books only. So having built up to that SLR to that extent, when the market movement is in one side, northward, nobody would like to build up and then try to have an MTM. You look at that, which is a big dent everybody had. And I wish to state to everybody that we have not taken even that, the forbearance given for the MTM. We just put it during this period. The indications of the reduction in the fuel price, the indications of the market perception of reduction in last couple of days, there is a correction is taking place by reducing. This, by our RBI's MOM operations, which is just coming into the strengthening of the rupee, this will give some fillip. Maybe in the next quarter onwards, we feel that it will stabilize. Therein again, the people will be able to, because once the avenues of credit expansion is just shrinking, the people may go into it. Today, little hold back attitude because of that MTM shock which the people had it for the last quarter.
Right. So you have had rounds of discussion on this with RBI and the ministry as well?
See, not exactly the discussions on that. These are the things which normally is not discussed. They keep watching the market and they keep moving it. No specific discussions take place normally in these areas.
Okay, and I'll ask Liberty to ask one last question. Do you see the loan book expanding from here on? Will we see at least a 10% growth, or will we still see a flat loan book growth, maybe 0.1%, and the RWA reduction continues? Which one is more likely?
The industry, if you look at it, there will be a very moderate growth because that...
IOB, sir.
Yeah. As far as IOB is concerned, as I said earlier, I will be hold on for a couple of quarters and then we'll go for expansion.
Okay, so the loan book continues to shrink.
No, it's not shrink. Hold on, I said. You see, if you look at it in the last 2-3 quarters, we were able to holding on to the current level of 151, 152, 153. We are trying to rebalancing it. That means what? My average yield, we are interested to earn more revenue by replacing my high cost with the low cost. Low risk, and replacing with an NPA with a fresh one. If you look at it, last year, my entire recovery to the tune of around 12,000 crores, other than that rate of amount, if you look at it, the entire thing has been replaced, which is nothing but a disbursement which has taken place. So 12,000 crores disbursement is a fairly big amount of disbursement. It is not growing to the tune beyond for the simple reason. See, because of the NPA, recovery is fairly high. That much replacement takes place. If my NPA level comes down, the recovery comes down, so anything which is building up will be over and above the book. So which I feel that will start looking up from Q4 onwards. By then, we wanted to shrink our NPAs.
Right, excellent, sir. And sorry, one probably at the final question. Based on that RBI circular of 12th February, what is the total size of pool on which we had a 1 rupee 1 day default that we are carrying and we need to rectify?
See, if you look at it, all these 2,000 crores and above, more or less it has been recognized, and I have a very, very small book, maybe to the tune of around 1,900 crores is what it is looking in that particular, which comes under that particular criteria.
And I believe most of it will be in power, or at least 70%?
No, our power is little, 1 minute, I'll just hold on for a minute. I'm not able to lay my hand on it.
Maybe I'll take it later from you, maybe.
Okay, I'll just take it later. Because sector-wise, I don't have it right now with me. Yeah, I'll ask somebody to get in touch with you and take it.
Okay, sir. Thank you very much, sir.
Thank you very much. Thank you.
Thank you. Anyone else who wishes to ask a question at this time may press star and 1 on their touchtone telephone. Anyone else would like to ask a question may press star and 1. As there are no further questions, I'd like to hand the conference back to Mr. R. Subramania Kumar for closing comments.
Yeah. Thank you very much. As I said about it, we set on to the path of turnaround, and the part of it has been achieved, but for the regulatory requirements and other things, there's a small movement or deceleration hiccups, which we are confident of getting over. We are working towards the turnaround of Indian Overseas Bank. I'm pretty confident that we'll be able to achieve it by in a year's time. Looking forward, this year we'll see the recovery, and the next year we'll see accelerated growth. This is what I wish, and then thank you very much, all of you. Thanks.